For what she's watching right now, let's bring in Katie Stockton, founder and managing partner of Fairlead Strategies. Katie, great to see you.
You too.
Let's talk about crude oil first. We have a pause in this rally. It's obviously been a very aggressive move. Do you take any significance from the fact that the oil couldn't make more headway today? There were some what would have seemed bullish headlines around, banning Russian imports and things like that.
Well, I mean, it definitely has very strong positive momentum behind it, and it's not really something that we necessarily want to fight. The fear here with this kind of very, very steep uptrend is that you come in the next day and it's gapped down like 20%. I don't know what would be the driver of that, but it does feel a little bit tenuous here just by the steep nature of the up move. This move this month in March is very strong already, and it follows two very strong months. I looked at the sector returns for the S&P 500 today, and it shows energy in the S&P 500 up 31%. And the second runner up was consumer staples, and it was in negative territory. So it really goes to show how strong this sector has been aligned with the rally in crude oil. And it just starts to feel like at a certain point, it's a bit too stretched. We do have overbought readings really across the board. And in some cases, those overbought readings are affirmed by the DeMark indicators, but we don't have that momentum downtick yet.
Speaking of momentum downticks, let's talk about financials a little bit, because obviously a very favored group coming into this year made some new highs, as a sector, and now has had a pretty stiff pullback. How are you viewing it at this point? Do you still think that this uptrend is intact or not?
It's a little tenuous here, too. I mean, this is an uptrend that's definitely lost intermediate term upside momentum. We've been trading mostly sideways to lower for the broader financial sector. If you look at something like XLF, and that ETF is now essentially testing some key support on the chart. And also the 200-day moving average for one has been taken out. So those are not good things, of course, for the financials. And we are seeing some breakdowns from a bottom-up perspective there, too. But like so many stocks in the broader market, we do have a short-term oversold upturn. So I think we'll see a loss of short-term downside momentum at a minimum, especially as 10-year Treasury yields kind of try to find their footing within their consolidation phase. I do think that it's all about Treasury yields right now. And the 10-year yields have come into potential support around 1.7. We've been looking for them to kind of plateau here, go sideways to lower. But after that, we do look for Treasury yields to work their way higher again. And of course, that could be a positive catalyst for these financials, which of course have underperformed for a couple weeks, but really overall year to date, they've done better than average. So it's not a broken story, but I really think we need the Treasury yield to kick back in on the upside to get that relative strength to improve. As it stands, the XLF is very much range bound versus the S&P 500. So we really want to see a breakout from that range as a nice positive catalyst supporting our performance there.